you're probably paying way more in taxes than you should. All right, let's cut to it. Most contractors are getting hammered on taxes, and it's not even their fault. It's happening because nobody sat you down and showed you the simple moves you could be making. So today I'm going to show you exactly where contractors like you are bleeding cash, and more importantly, how can you fix it starting this year. If you haven't met before, I'm Sammy Basta. I work with construction business owners every day as a CPA and fractional CFO. I help guys like you keep more of what they earn, plain and simple. So let me show you how. Here's the problem. Contractors are getting treated just like another small business by their accountant. You are not. Your world is different because you're dealing with cash flow swings, equipment, job costing. You're not a coffee shop. And because of that, you're probably paying way more in taxes than you should, but you don't have to. So let's start with this big one, entity choice. If you're still operating as a sole prop or a regular LLC, plain vanilla, you're likely paying a fat chunk of taxes, up to 15.3% more in self-employment taxes alone. That could easily be $20,000 to $30,000, even $50,000 for some of you. So switching to an S-Corp might sound like a pain, but it's a no-brainer because that would put that money right back in your pocket. And it's not that complicated if you plan ahead. Here's another one that I see all the time. No tax planning. Your CPA shows up in March, file the corporate tax return, says, hand you the tax bill, here's how much, you have to pay, and that's it. But the real moves, the real planning happens before the year ends. Good tax planning happens in the fall. So waiting until the tax season, that's a donation to the IRS. Let me guess on this one. You bought a truck, a generator, maybe even a new trailer last year. Most contractors don't fully take advantage of bonus depreciation and Section 179. That equipment could have knocked tens of thousands of dollars off your tax bill, but only if you plan for it. Done right, I've seen guys cut $50,000, even more legally, just with that one strategy. Here's a sneaky one. Bad job costing means that your books say that you made more than you actually did, which means that you're paying taxes on phantom profits. So cleaning up your job costing, and not only your numbers make sense, but your tax bill will often drop fast. Let me give you a real example. I worked with a drywall contractor, pulling about $3.5 million a year. Before we met, he paid $185,000 in taxes. Well, after we got their entity structure right, took proper depreciation and fixed the job costing mess, their tax bill dropped by $67,000. That's not bad for a couple of tweaks and some good planning. So let me show you how to fix it. Here's what you need to do. It's not rocket science. Step 1, don't wait until April. Step 2, get ahead of it. Step 3, structure your entity the right way. Step 4, use every deduction you're legally entitled to. And last but not least, work with someone who actually understands construction, not just a small business CPA in general. So if you want to know exactly where you're leaving money on the table, click below and just leave me a comment or ask me a question. You can also schedule a complimentary call with me. Either way, you will walk with the real actionable advice from our office. If this helped, hit subscribe, and I'll be back with more straight shooting tax advice for contractors who want to keep more of what they earn. I want to thank you so much for watching this video. I'll see you next time.
This has been another episode of our tax saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bastacpa.com. Thanks for listening, and have a great day.